The Federal Reserve is not yet done raising rates, according to their latest meeting minutes. What does this mean for the markets, gold, and the dollar? Welcome back, Gary Wagner, editor of thegoldforecast.com. Good to see you as always, Gary.
Thanks for having me, and it's great to be here.
So, as you know, the Federal Reserve left rates unchanged at the last meeting. Now, on Wednesday, as we're speaking on Wednesday, the minutes came out which revealed that they may hike again, and in fact, twice more. Jerome Powell has alluded to this in the past, and the question is whether or not this will have any significant impact on markets overall, or if this move or their future moves are more or less telegraphed already.
Well, it's interesting. The ECB held their annual forum in which he spoke on a panel with Lagarde and a lot of other governors and heads of the central banks worldwide. Everyone seems to be raising rates. Inflation is a global scenario. And the one thing that he said that kind of stuck out is we're not taking 2 consecutive rate hikes off the table. Right now, it's a very high probability that the next FOMC meeting will result in a 0.25% rate hike. I believe it's 88.7%. According to the CME's FedWatch tool. But then if you go out to September, it's only 17.7% that would be followed by yet another rate hike. So the jury is out about 2 consecutive rate hikes, whether he said that he will do 2. And I believe that he most likely will stick to that doctrine. I don't think it's highly likely we'll see 2 in a row.
What would need to happen before the second rate hike for him to change his mind on the second rate hike?
Okay, there's 2 key reports that are going to come out prior to the meeting. I believe on the 7th is the jobs report. And that's been a very, very strong component that has affected core inflation. And core inflation is where they're having an issue. And then after that, we have the CPI report coming out, I believe, on the 12th. So both of those meetings will come out prior to the Federal Reserve holding the next FOMC meeting. Depending on those numbers, it will certainly influence the ultimate decision by the Federal Reserve as to whether or not they're going to have 2 consecutive rate hikes. I believe that a single rate hike is pretty much factored into the market and almost a no-brainer, so to speak. It's what he said, and I believe that's what will occur. Because when he talked about the pause, he said, this isn't a significant move in that we are no longer raising rates. We simply want to have time to assess how well our tools have used to impact inflationary pressure, because there's an intrinsic lag between when we raise rates and when we see the outcome of those higher rates. So he made it clear that the pause wasn't a halt. He also made it clear that they're not going to lower rates this year, which leaves us the only option. He will raise rates. He said most likely to. We'll keep him at his word. And whether they're consecutive or not, I don't believe is as important as the fact that they're going to raise another 0.5%, taking I believe we're at 5 to 5.25, which would take us to 5.5 to 5.75 in terms of Fed funds rates.
Gary, you live in Hawaii where the service sector is a dominant industry. Are you seeing any slowdown in that sector?
Hawaii has a huge percentage of population that works in the service sector because our main industry is tourism. You also have the fact that we are in our summer months. So what we're seeing now could easily be seasonal, although we get visitors year in and year out throughout the entire year. This is our peak season. In fact, where I live, I can see planes landing over the water about 2 miles from me. Right now, they're coming in at about 5 to 10 minutes apart during the day. And so what happens is when we get into peak time, there's a constant flow of airplanes coming in. Tens of thousands of visitors are coming in on a weekly basis. And so That's going to remain strong. Of course, it's just picked up after the recession and all of the problems that we had a couple of years ago. And so it does seem to be normalizing, but it is very strong.
That's interesting. I wonder, I don't know if you've have any data or personal observation. Are these visitors American or are they foreign tourists?
Um, it's it's both. The Japanese are a large percentage. China is filling out the gap there, but we have a lot of visitors from the U.S. So it is definitely both.
When we're talking about the labor market, that's what a lot of people are concerned about. Any signs of weakness over the next 2 quarters that you see, Gary?
Well, considering that last month we came in what over 300,000 new jobs, right? The predictions and forecasts right now are that it will come in as a strong report again. Whether that will be 250 or 300,000, we'll have to see. But that is the current forecast. So I expect to see a strong jobs report with a little uptick possibly in the labor market tightening due to more people hitting the unemployment lines.
And the stock markets have certainly been resilient, as have certain economic indicators. Although you are seeing things like the leading economic indicator trailing down, PMI has been going down. So there's some weakness in some pockets of the economy, whereas the markets, at least the equity markets, seem to be holding up well. What do you think gold is telegraphing, or the gold market is anticipating, with its price near
Well,
$2,000 still? Yes.
yeah, the problem we're having on in terms of seeing gold have any kind of meaningful rise is as long as rates are going to be raised and the current level is absolutely an elevated level, that is difficult to attract investment dollars when you can get a 5% yield on a CD or a government bond. It's been a long time since fixed incomes were able to get that kind of attractive return. And of course, bullion is a non-interest yielding asset. And so because of that, it has a very hard time gathering momentum for there to be additional purchases. The other thing that you want to realize is the dollar has begun to have some strength again. That does make it, because it's paired in dollars, more expensive for foreign investors to buy gold.
Right. Can we pull up a dollar chart actually and talk about the technicals? So you're right. It's been seeing some strength since the beginning of, well, actually since 2 weeks ago.
Yeah, certainly. Give me a second.
And while you're pulling up that chart, this strength that we're seeing, is that in anticipation of more interest rate hikes, or Fed funds rate hikes from the Fed?
I think we should have a weekly chart up. I just wanted to confirm that of the dollar index. And so what you see is that in the middle of the chart, those highs come in around 114, and the dollar had some extended weakness in which it went from about 114 down to just roughly 100. Over the last 3 weeks, we've seen it pick up. It's sitting at about 103 right now, and it doesn't have technical resistance till about 104.45. And the key is, as long as rates remain elevated and there is a very decent return on government debt instruments and even banking instruments, it does become an attractive avenue for investment dollars, because there's basically little to no risk on buying a 30-year bond or a 10-year note. And if you're getting a guaranteed return around 5%, and you're comparing that to potentially getting an 8 or 10% return in equities, but also potentially getting zero any or a decline in return in US equities, you're seeing a lot of capital move from stocks into the fixed income, but the equities are still exceedingly strong in certain sectors, specifically tech. Tech has been on fire.
And the dollar is not strengthening then in anticipation of a stronger recovering economy?
I think that the dollar is strong because the yields are going up, and attractive yields for treasuries, any kind of U.S. debt instrument purchased in dollars is going to be supportive of the U.S. dollar. I think this recent strength that we're seeing in the dollar is based upon returns at current levels, not in anticipation of further hikes.
Right. And do you think that continued strength in the dollar is likely to persist then, Gary, following this momentum we've seen in the last 2 weeks?
That could easily occur if they continue to raise rates. And that is pretty much the assumption that all or many analysts are working on. Yes.
Okay, that's interesting. So then what we're seeing then is basically a higher dollar predicated on continued strength in the labor market, because that's what would push the Federal Reserve to continue raising rates, and perhaps continued strength in inflation numbers, because that's what also would incentivize the Fed to continue raising rates. So then we have to look at inflation. We haven't talked about inflation yet. Are you seeing any inflationary forces persist, or are you starting to see signs of disinflation beyond what just the CPI numbers are telling us?
Well, we've got the next numbers coming out on the 12th. And if you look at the most recent numbers, we went from, and I'm talking about core, we went from roughly 5.5 to 5.3. That still is an elevated level. We've seen headline inflation tick below the level of core inflation, and that's unusual. Right now, the nowcast by the Cleveland Federal Reserve is predicting that the next numbers, meaning the numbers coming in for June, will come in at around 5 to 5.3%, which is right around the same rate it's currently at, and that means it remains elevated, and that is worrisome for the Federal Reserve, because what it says is, even though they continue to use their tools, they continue to raise rates, they continue to reduce the money supply, inflationary pressures remain in certain sectors.
I think based on our discussion, it's reasonable to assume that a lot of these sticky forces will remain, at least in the short term. What does this mean for gold then? Let's circle back to the gold technicals, and perhaps we can show a chart on the screen. So like I alluded to earlier, near $2,000. It's been hovering around this range for a while. The dollar, like you said, has been weighing down on gold. If we think that short-term strength is going to remain in the dollar, then perhaps we can see short-term weakness in the gold price. Can we not?
We could. Let me go ahead and pull up a gold chart. And this, of course, again, is going to be weekly. And what you can see on this weekly chart is we've had on a weekly candlestick chart, 4 consecutive weeks in which gold has traded to a lower price. And the bigger picture is that the absolute high we've hit this year occurred about, call it 2 months ago at 2,083. And we had a low last week that came in just above $1,900. I have technical support between $1,900 and $1,915. One is based on a moving average. The other is based on a Fibonacci retracement number. But the key is, if it cannot hold this level, we could break below 1,900, and that's going to be the question. So what would it take for gold to hold this current area? Something that alludes to the Fed softening at some point. In other words, if the statement from the next FOMC meeting contains any kind of dovish talk, not necessarily action, but a softening of tone, that would be highly supportive, because gold traders are looking to find a reason to bid gold prices higher. And it's difficult when inflation is running hot, but yet people are focusing on interest rates being elevated and rising. So it is caught right now at around 1,900, 1,925. And the question is, can it hold 1,900?
That's a great question. What's your insight there? Certainly, I don't have the answer, Gary.
I think it's going to be contingent upon what inflation does, what the jobs report does, and how the Fed reacts to it. They're going, it's pretty it's very highly unlikely that they will not raise rates another 0.25%. It's also highly unlikely that they will enact any rate cuts throughout this year. Let's forget about whether or not they do 2 rate hikes. I believe that they will. But the fact that there is a real cost to money now, and there hasn't been for years. We've gone from virtual free money, 0 to 0.25% in terms of borrowing, to 5%. And that changes the entire fabric of looking at a safe haven asset versus a asset that either has a fixed income return or equities. Both equities and fixed incomes have had very respectable returns. And so it takes away the incentive to allocate larger percentages of your portfolio to gold or silver. And that has kept it under pressure. I don't see that changing without one of those components changing. In other words, if the Fed comes out and says, I don't think we need to be as aggressive anymore, that would have a boost. If they said we anticipate that we'll cut at the end of the year, that would be a huge boost. Or if inflation came down dramatically, their target is still 2%. And especially at the ECB forum, it was a unified voice from all of the central banks that they're all looking at a 2% target. Many analysts and economists, including myself, believe that's pretty much very unrealistic at this time. And so if they maintain, they want to get it to 2%, and we're sitting at 5%, it tells you that we've got a ways to go before they bring inflation to a level that they believe is at their target. Because what they do not want to see is high levels of inflation become entrenched in the economy. My sense is components already are entrenched, and their tools are not being effective as they have in the past or hope they would right now.
From an investment standpoint, Gary, is there an investment case to be holding cash right now? When you think about it, inflation on paper, at least when you look at the CPI, the headline CPI numbers have been coming down. Interest rates are going up, at least in the short end of the curve. Money market yields are going up as a result of that. Perhaps people can park their cash in a money market fund or a CD, earn some yield and equal inflation, if not beat it in some cases.
There is a case to be made to have cash and fixed income. There is no case to be made to just have cash as cash. Cash is giving you less buying power year over year over year. And when compared to the other currencies, because they're also raising rates, which make their currencies attractive, it doesn't make sense to just keep money in cash. Now, to keep it in fixed incomes, it does make some sense because there's very little risk and the return is reasonable. 5% return on a fixed income guaranteed investment is something that you couldn't do 2 years ago, 4 years ago, 8 years ago. We'd have to go back historically, 10, 15, I'd have to look at the numbers, but quite a ways to see the last time you were able to get a CD or a money market that produced 4%. Because for as long as I can remember, if you were getting 0.25% return on a CD or something, that was considered what you were going to get.
Could gold remain competitive as an investment asset in light of what you've just said?
Well, it's always going to have an allure that fiat currencies don't have, because this is something that we haven't talked about, and that is that as a whole, currencies, not in terms of dollar strength or weakness, because when we talk about that, we're talking about the dollar compared to the euro, compared to the yen, compared to a basket of currencies that make up the index. But if we look at the buying power of the euro, the buying power of the dollar, the buying power of the yen, it has diminished year in and year out. And so that while there is a reasonable return of 5%, if inflation is eating up, say, 4% of that a year, what's your real return? It's nominal. It's maybe only 1%. So there's a safety factor in gold. And I believe that in any scenario, it's unlikely that I could find a scenario, in other words, in which a portion of your portfolio should not be in gold. But the percentage of allocation has to be much smaller than it would have been a year or 2 years ago. But there's always a reason to have some of your portfolio into a hard asset.
Okay. Gary, thanks very much for that analysis. And where can we learn more from Gary Wagner and your technical analysis?
Thanks for asking. Thegoldforecast.com is our website. We have a YouTube channel, and I can always be reached out at Gary S. Wagner. I add that in terms of Twitter.
Great. All right. Thanks very much, Gary, and I look forward to catching up with you again soon. Take care.
Have a great summer.
Yep, and thank you for watching. Don't forget to subscribe.